Welcome back to the Lobster Talks, where we talk everything YC with the best founders. Today, I take you behind the scenes of the latest YC Spring 25 demo day. We're going to talk about what I saw there, what's happening, what are the big trends and the big takeaways. So let's dive in. So anyway, this demo day was very different because it was in the YC office, and so there was not enough room for everyone to sit. So I was there. There was not enough room for anyone to get in, actually. So I was there very early, one of the first to go in. Then people were turned down. Like when demo day started at 10, people were still outside. So
Because they've been like talking outside, or they were
no,
late,
no,
or
because they wouldn't let them in. Because they wouldn't let them in. It was at capacity, and then they let more people in later on. But like if you wanted to see the opening of demo day at 10 a.m., it was full.
mm.
So that's a crazy thing. And then even if you make it inside the YC building, inside demo day, ground floor is just people talking, networking, a little bit of snacks and drinks and stuff. And then first floor is where it's actually happening, but you couldn't go up. There was a queue, and almost the entire day there was a queue. Like you had to wait 10, 15, 20, 25 minutes just to go up because it was at capacity again, and so you had to wait for people to come down, which is like I think it might sort of be on purpose to create FOMO
So
or
were
something.
the last demo days was where? Like,
They had it
but
at
how did
different
they
places, like
fit
the
people in?
the Masonic Center in SF, and the there's like a bunch of external places that are not the YC office. It was the first time back in the YC office, and yeah, the place is not huge. I mean, it is big, but it's smaller than those other reception events that they had it to. So there's a maximum number of seats, and it was not a lot of seats compared to usually. So yeah, I almost thought it could have been maybe on purpose to be like, oh my god, you're not even able to get into the to listen to the pitches. But actually I think it's just the size. I don't know if they just wanted to cut costs and do it in-house, or were not able to secure a place. I don't know what happened, but it played, I think, a role. Some people were pissed. Oh, I can't even go and listen to the pitch. So you're downstairs and you're just looking at on the screen. And so you're like,
Oh yeah,
I could
okay.
just stay home and do this on the screen. Of course, the whole point that's interesting is the whole point is not to listen to the pitch, is to talk to people. That's the whole thing. But that was crazy in a sense.
Uh,
It's good to be back. Let's talk about YC Spring 25 demo day that just happened. We have a lot of things to cover and tell you about. So let's dive in. Laurie, thanks for being here again.
yeah, it's good to be back, and we're doing the demo days more frequently now. There's 4 a year. This is the first ever spring batch, and there was 90% companies focused on AI, and the biggest growth recorded in YC batch with 12% weekly growth. And this batch also had a 0.8% acceptance rate. So how do you think it kind of went, and are you seeing that those kind of impressive statistics translate into the batch quality?
Yeah, it is exciting all along, all the way. Like everything's exciting about this batch. 0.8%, like you just said, acceptance rate means they didn't compromise because it's the first spring batch. You could think there's going to be less people applying, so we're gonna take whoever and accept 3, 4, 5%. 0.8%. That's one of the lowest. It's quite usual. It's around between 0.8 and 1.1% usually. So still very low. So that's very interesting. That's still very many people applied and quality founders. It was 137 companies presenting on demo day and roughly 140 and some change companies in the batch. So same thing. You could think spring, no one's going to want to apply. People came and applied. And for 3 batches in a row now, right? Beating the record on growth and revenue. And that is probably one of the most interesting things. YC is just getting better. And startup building probably overall is getting better with AI. AI allows you, we've talked about this at length, to build better, faster, but to also sell and go to market faster and better. And that's exactly what we're seeing here. It is beating records. I've heard someone say this, the accepted number and statistic on YC is around 6.5% unicorn. It's very interesting because if you look at there's been more than 5,000 companies now who went through YC, and only 101 unicorns today, which is not 6%. That's 100 of 5,000 is what, 2%. But this 6.5% is taking into account that the more recent companies have not yet had the time to graduate into unicorns. And so it's sort of an invented number that we think this is what it's going to look like based on the most recent batches that did have unicorns graduate, but there's probably going to be more. So we don't know about this number. It might be too high, but what's interesting is it might be too low. And that's what more and more and more people are thinking right now. I've heard someone say this batch, he gave a number. I think he said 20 unicorns out of 140 something companies, which amounted to 13-14% unicorn rate. So of course, we don't know for sure. We'll know in 10 years, but that's how impressed people were with the batch. That's what they saw in the quality of startups. And you can really, I think you and I talked about this, that YC is almost a YouTube channel attached to an incubator. So YC really is attracting the best and brightest and most ambitious founders in the world. It's giving them the best tools. It's giving them a pressure cooker with, demo day coming up and all of their peers building together. So if you put all the smartest and most ambitious people in a room and give them this time pressure, the results are going to be amazing. So actually, I'm part of the people who believe that could be true. It could be true that it's more than 6. It could be 10, 15% unicorns in 10 years. Let's see. Obviously, we don't know yet, but overall, very impressed with the quality. And I'll tell you something else. I'll end it there. I saw at demo day a lot of people who were not usually investing in YC, who were coming. Many people I met, not just once or twice. Many people were like, "Oh, we usually don't do YC too much, but we're here. We're curious. We want to see what's going on." I even heard someone said, our fund structure doesn't allow it, so we've never invested in YC, but this fund manager said, "I'm fed up. I've missed so many good deals. I'm changing my fund structure to be able to invest in YC companies going forward." And she was here for the first time because she said, "I've missed so many of them. I don't want to miss again." So very impressed with YC overall, honestly.
Yeah, last week we had another exited unicorn from YC with Scale AI selling to Meta.
I think actually,
So
sorry to interrupt you, but I think we should talk about something as well that was quite popular on social media last week. I'm sure you saw this post. Oh, YC had 0 win in the AI space. You've seen that, right? It's been everywhere. People tagged me like, "Oh, Gabriel, you invest in YC. You're so wrong," etc. Okay, so Scale AI is a YC company. That's just one, a counter example.
12.5 billion.
Massive exit, valued at 15 billion, exited from Meta, not, a small corner of the world, like Meta, one of the biggest players in AI. So that's one. But another huge AI win from YC that everyone forgets about is OpenAI. OpenAI was created at YC. So it's not part of a YC batch because it was YC's research lab. But remember, Sam Altman was YC's CEO at the time, and he's the one who started OpenAI inside YC, who then left to do something independent. But it is a company from YC nonetheless. So it would be very tough to argue that YC has 0 win in the AI space when they have the biggest, literally the biggest number 1 player in the world for now. Not sure if OpenAI stays the winner in 10 years, but today they're one of the biggest winners. So I just wanted to, mention that because it's been popular on social media last week.
Yeah, and so prior to that, we were talking about the revenue and how the revenue is growing, and there's almost like a lot of pressure now and expectations for companies to show up to demo day with a lot of revenue. How are you kind of doing that revenue due diligence? There's a lot of talk around like, oh, these companies, they're part of this new wave where a new AI tool comes out, so everyone wants to try it, so everyone signs up for 3-4 months and then churns. How are you thinking about like revenue due diligence? Are you looking for verifying that revenue is not coming from batchmates, or are there kind of other things that you're looking for in what that is?
Yeah, absolutely. So I tried to crunch some numbers and I didn't get everything exactly right. So this might not be perfect because some companies report LOIs, some companies report volume, processed, but that's not revenue. But then I fed everything into an LLM, and the LLM was not able to, make everything out perfectly. But it seems there's roughly 70% of companies that actually have revenue. There's 30% that don't have significant or reported revenue at demo day. And I came up with average revenue of somewhere around 66K on average, including companies that don't have anything, companies that do well. Which that's interesting. I think it's going up. I don't have the average out of the previous batches, but basically what I see is there's more and more companies doing revenue, and there's companies doing more revenue than before. This is something that we've also talked about. The over 100K, there's more than before. And then there's a lot of companies over 500K, which before was maybe one per batch was the exception. But in this batch, there's, probably at least a dozen or more that do more than 500K in revenue. So that's one thing. On checking the revenue, you're correct. Everyone knows that. We've seen it. People try the tool, big revenue spike, and then churn. So I really have 2, maybe 3 ways of checking against that. One is you do want to ask for the churn, for the cohort, for the retention. And if it's too early, many of those companies only have 1, 2, 3 months of selling. You have to be wary of that and be like, okay, it seems good, but I don't know if those people are staying or not. And some of those companies have been around for longer, 6, 9, 12 months sometimes. And then you have more data and you can make a better decision. I invested in a company that's been selling for 9 months and the retention is amazing. And so that actually you have the data for a longer time. So that's one thing. Second thing, you mentioned it, is batchmates. And so I actually passed on a company, this batch, literally a few days ago, that almost everything was great. It's not the only reason, but it's one of 2 reasons why I passed. That more than 50, so tons of revenue, over 500K. So that's pretty rare, pretty exceptional. That's one of the reasons why I was interested. Amazing product, amazing founders, like lots of good things. But then they have, I think, 56 customers. It's B2B. I think they have 56 customers, and 30 out of the 56 were batchmates, because they sold into the batch, into something that everybody needs, almost everybody needs. And so it was very easy to get them. And so I ask them, and it plays into my third thing. So the second is batchmates. You can ask them. And the third thing that I'm doing is GTM, go to market, customer acquisition. What do you do to actually acquire a customer? So that's the question I asked the founder. Okay, you've got plenty of batchmates as customers. That's okay. Is YC a big part of your go to market? Yes. Okay. You want to get the next future batches? Yes. Okay. How do you do it? What's the plan? What's the technique? What are you setting up today to make sure that you get at least 30 or more of the next batch and the next batch and the next batch? And here, his answer for me was not good at all. Basically, he had no idea. And he said, oh, we're going to do the same thing we did now. But of course, if you're in the same batch, people know you and talk about you and they see you. But if you're not in the same batch, that's it. You're old news. People don't know about you. And so you would have to probably, I don't know, find a way. And it's not for me to figure out, it's for the founders. Find a way to make sure that everyone in the new batch knows you. Maybe you run, events and happy hours, but of course everyone tries to do that. You can run a YC deal where, YC companies get a discount, but again, everyone tries to do that. So it's not very easy. I want to have something and to understand that the founder really thought about it and have figured something out. And in this very specific case, he hadn't. And so I passed on the deal. And that's, again, only one of the 2 reasons that pushed me to pass. So check on retention, metrics, churn. Ask about batchmates. But more importantly, out of those 3 is check for go-to-market customer acquisition strategy. Because ideally, you don't feel a leaky bucket. You got to fix retention first. But even if there's some churn, it's never 0 or 1. There's always more churn than you would like. But of course, not everyone is churning. But if there's some churn, but you know how to fill the pipeline all the time, then you can also try to fix the churn and retain everyone and grow. And so, that's we always come back to one of my favorite things, and I've been repeating this to so many YC founders at Demo Day. How do you get customers while you're sleeping? It is so important, and sadly, still a lot of people neglect that. Not everyone. Some people are very good, and that's the type of people that I want to invest in. So that's how to answer your question. Revenue is great, and that's sort of the front thing. Oh, I'm investing in companies that have great revenue. Yes, of course, it's a little bit more subtle than that, and that's why I'm here. I need to get into the subtlety, and that's where my past as a founder comes into play, because GTM is one of my specialty. Maybe specialty is not the right word, but something that I know that I've done a lot, so I can understand and challenge them and make sure their answer is satisfactory.
And within the batch, we heard that 90% of the companies are AI focused, 67 of them, which is just over half the batch, are described as specifically AI agents. And there's a lot of maybe overlap between them, with a lot of people, using the new kind of Uber for X as being cursor for X.
Yep.
When there's so many similarities, how many companies are you evaluating, and out of the whole batch, and like then how within those ones that you evaluate, what makes certain ones stand out?
So there's different levels here. You, of course, check out the team and the founders and see how strong they are, and that gives you an idea of the potential. But it's not always true. Sometimes you have 19-year-old dropouts who are going to build the next unicorn. So you got to be careful of that. By the way, I met the youngest YC founder of the batch, who's 17. I did a quick video with the founder. It's on the YouTube channel. You can find it and check it out. But impressive to meet a guy who's 17, who's already in YC, first company. Imagine where this guy is going to be 10, 20 years from now. So that's also the power of being in San Francisco, in Silicon Valley, rubbing against those guys, meeting them face to face. Like, we're not best friends. We met like 10 minutes, but we spoke, and I'm very excited to follow this guy's journey over the next 10, 15, 20, 30 years, because I think there's good chances good odds he's going to go somewhere and build something amazing, even if it's not this one. So you check the founders. I always sort of check the idea, even though I'm not a big believer in ideas in general, but you get an intuition. I've been investing 12 years, and so I've seen tens and tens of thousands of companies now. So you get a first intuition. But at the end of the day, one of the best judge of the future success of a company, at least in my experience, is the speed of execution and the early traction. And the early traction comes from the speed of execution too. So if you're a team and you move very fast, and that's what YC teaches you, that's the pressure cooker, and that's the 12-week deadline, you're going to be able to build and ship and iterate so quickly that that's your edge. You're getting an edge on everyone else because you run some experiments and just know what works, what doesn't, and just iterate. It's like Darwinian. It's evolution. If you have gene mutation every day, you're going to adapt much better than if you have gene mutation every year. And so that's what it is. It's gene mutation. You ship something, you show it to the customer, you see what sticks, what works, what doesn't, and you go back at it. So that's really the number one thing that I look at. And within YC, not everyone ships as quickly. YC is this pressure cooker for everyone, but some people are faster than the rest. And usually those are the people at the end of the batch who end up having the most revenue. It's very, very linked. And again, revenue is one of the ultimate proof, because customers vote with their credit cards. If I'm paying for something, of course, we have to factor churn, retention. But if I'm paying for something, it means I'm interested. I want to use it, even if it's something that I want to try. Of course, if it's like a $20 AI tool, but some companies pay 1,000 more contracts. Like even if it's for 1 or 2 months, you still thought it was worth it to spend $1,000 to try it. People don't spend $1,000 like this. Money is money, right? So, and then of course you have companies that only make usage-based commission. You have companies who, make money when people are actually just using it. And that's also another way to measure, there's not going to be churn, or maybe there will, but it's very, they're not just trying it out, they're actually using it. So, now that being said, there's a lot of similarities. That's true. So you got to, place your bets. Maybe in the one sector, you got 3 companies in this same batch doing the same thing. Who do you choose? Well, what I've just said is stars give you some keys. Who's the stronger team? Who's iterating and building and shipping the quickest and adding more features and answering customers asks, etc. And then who has the biggest early traction can be a good start. Then you meet the people face to face, and that's where the magic happens. That's why demo days in person, and that's why we don't invest on paper. I never invest without talking to someone, rather, and I think very few investors do. So all of this, I can rationalize all of this, and I do, and that's my job, to figure out pathways. But at the end of the day, you talk to the person and see what they have in their gut, and that's another part.
Hmm. And I saw an interview with Andy McLaughlin, who's a British investor, but he invests with Uncork in San Francisco, and he was basically saying like YC's getting increasingly good, so you have to differentiate between what's pretty good and what's really, really good.
I
And
agree.
that's kind of what you're alluding to in there. I just be interested to touch like within that, obviously, as there's hype or as there's companies that are getting to this revenue faster. And you also mentioned how there's now more investors from even different areas or different sectors who are now looking into YC or reallocating their funds to invest more in YC. The competition for rounds obviously goes up. And before this call, you were mentioning how there's one company that was, I think, 12 times oversubscribed. How do you, as an individual, or how should investors be competing for that kind of allocation? What are the strategies there? And then also yourself as well. Like, is there a European angle for you within that?
Well, yes, competition is fierce, and I I'm lucky that I'm often able to get into very hot deals for a number of reasons, but it's not 100%, and I want to be 100%. And so, how can investors compete there? I'm not sure. You got to bring something to the startup that only you brings. If you're able to say, hey, take my check, but I'll get you this X, whatever it is. Uh, it's a pretty compelling offer, but you got to make this offer good enough for all the startups you want to get into. So some rounds, yes, were massively oversubscribed. You ask me if there's a European angle, I'll tell you the truth. I use whatever angle I can or whatever angle is relevant to get into the deals. That's my job. And like I said, I think I'm usually doing an okay job because often I'm able to get into some hot deals. In this batch, I've made 4 investments so far. I might do a fifth one. That I made 4 investments, and there's 2 that were closed when I talked to them or oversubscribed, but I still managed to get in. So I'm pretty happy with that. Uh, but it's not 100%. Some people are so much oversubscribed. So what happened with this 12x oversubscribed is I got in at a lower valuation, but because they were oversubscribed, they increased the valuation and say, okay, we'll take whoever is willing to pay a higher price. And that was not worth it, in my opinion, because the price was getting extremely high. Already the baseline was high, but it was getting extremely high. So I thought, well, I can actually share numbers. The company was doing 500K AR and raising at 40 million valuation, which is already extremely expensive, but maybe you believe in the founder, etc. And then they came back and said, we'll do a 50 million valuation. So that's 100 times AR. And maybe I'm wrong. Maybe this company is going to kill it. Of course, I've often defended getting into the best deal ever, sort of regardless of valuation. That's often my position. But I've also always said there's some limits. I think at some points it becomes crazy. And so, 100x revenue, even though it's a fast growing company, seemed very, very rich for me. And so I ended up choosing not to do the deal. So it's a little bit different than not getting the allocation. I got it at a higher price. And so some YC founders will do that. They will use this incredible, interest from investors to lower their dilution, and it's a good thing for them. I always tell them, if you can get away with it, if you're able to raise at 50 and some people are willing to pay for it, then do it. Some other founders said, oh, we only accept uncapped MFN. So they raise whatever, but on top of that, it's uncapped MFN, and whoever wants to come can come. That's not my job. I'm here to be reasonable for my investors. I'm here to buy stuff at a price that I know. It's unreasonable to buy stuff at an unknown price. Of course, sometimes it can work out if it's, the next 50 billion exit and you get an uncapped at seed that's going to convert at the price of the Series A. It could work out, but I'm not a Series A investor, at least not yet. I'm a seed investor, and so yeah. But to be fair, I would sort of maybe do more of this if I was not able to get into most deals. But like I said, I'm able to get into many deals. And one of the things that help is, this media brand that it's part of what we're doing now, this podcast, what I'm doing on LinkedIn. It's, very active and working quite well. And I'm, branching out. I'm building now, I'm being more and more daily on X. And, you can follow me here if you want. I'm doing more stuff there. And a lot of YC founders are there as well. So I can, talk to them, engage with them and be top of mind and just support them before the batch, during the batch, and after the batch. It's going to be we're together for the next 10 years once I invest. So that's part of the thing. That's also the network. There's also the founder friendliness. Bookface, the YC tool, rates investors on how founder friendly they are and how helpful they are. I just talked about media. It's also how helpful you are to the founders, and founders know that. I've built companies, I've sold companies, I've been in their shoes, I've invested in more than 100 YC companies, and so there's a lot of things that I can help them with on many, many different topics. So that's part of the answer.
Mhm. Yeah, and on the high valuation things, I'd be interested to know what you're seeing from kind of later stage investors around YC companies or later stage investments more generally around kind of AI and AI agents. Because obviously, when you look at very, very high priced seed rounds, you think, okay, well, where's this going to go? What does that look like at Series A, B, C, or so on? And obviously, you can look over the last 10, 15, 20 years of tech valuations and even something like, Shopify or Netflix, Apple, Amazon, they all have done these like huge 10x, even 20x flips post IPOs. There is still huge amount of room for growth in these categories. But when you're raising these pre-seed rounds at 40 million, 50 million, have you spoken to any of these like later stage VCs? How are they thinking about it? And are those guys looking into the YC batches as early as you guys are?
All of the best investors in the Valley, so all of the best investors in the world, they invest in YC companies. And if you look at, Sequoia, Andreessen, whoever, Axel, Lightspeed, Initialized, very similar to me. And so I think that's one of, a great way of be a startup investor. They're not very price sensitive. They're growth and traction sensitive. So remember Wiz, the cybersecurity company that was acquired by Google for 32 billion. Their seed round was valued at 67 million valuation. It's not a YC company, but it's 67 million valuation, and they raised 21 million. That's in 2020. And in 2025, only 5 years later, they exit at 32 billion. And so that's a more than 200x return in 5 years. So what happened? Why did they raise? And they raised from the biggest, they raised from Sequoia, they raised from Excel, like they raised from the Index Ventures, like the best of the best, right? Well, they were repeat founders. Their first company, they already exited for something like 90 million or something. And they were building in a very hot and exciting space. They had apparently one of the best tool. I haven't tried it personally, but people say Wiz is sort of the best that you can, people use it and go crazy how good it is to use. And growing quickly. And so in that case, sort of who cares about valuation? Well, of course you care because you don't want to buy at any price, but everyone was willing to buy at a very, very, very high price. So that's what you're betting on if you're investing at YC at those valuation. Now, again, I think there's a limit because I was not able to get there personally in this deal at 50. But maybe I'm wrong. Maybe this is the next $32 billion exit and they're going to prove that it would have been a good investment at this price as well. So same for Series A, B, C. Of course, a typical Series A is maybe at a 30 or 40 or 50 million valuation. And if you have a 50 million seed, what's going on for Series A. But if you are into the category of one of the fastest growing, then you raise. I have a portfolio company in Lobster Capital that's in top 1% in YC in terms of growth. They did YC in 24, but since then they've been executing at an insane pace. They're a year old and they're closing in on 10 million AR. Like, it's crazy. So, and their seed was, well, expensive, not at 50, but expensive. But their Series A, by all likelihood, is going to be much, much higher price than that. It's probably going to be around the 100 million, maybe 150, 200, who knows? So the strong seed doesn't matter anymore. So that's the bet you want to take. Now, of course, as a seed investor, not all of those bets are going to work out, but if some do, and that's, remember, we're in a discrete distribution game. So if 1 out of 5 or 1 out of 10 bets works out, and if it's a massive exit over $1 billion or 5, 10 billion, then the math works. So, I don't want to criticize high valuations. I'm just saying, it's a different world, and you can, I've always mentioned you can invest in low valuation seed outside of YC. Many VCs do that. Oh, we want ownership target. We want 10% on a 7 million valuation, and YC is too expensive for us. Okay, but then your 7 million startup has 1 chance in 1,000 of making it, and your YC startup with $1 million ARR has probably one shot out of 10, 20, 30 of doing it. So it's very different math. And again, going back to this investor that I met, she told me, "Oh, we haven't done YC. We do, we have ownership targets." And now I'm changing my whole model because I realized that I've missed so many great companies. You don't want to optimize for price. You don't want to optimize for ownership. You want to optimize for the biggest exit potential. And remember, 1 out of 4 YC unicorn becomes a decacorn. So again, that's why I'm investing in YC and nowhere else. I think it is the best place, and we just saw it with Scale AI. Again, it's one of the best places to look for massive outcomes.
And so within that, like looking forward then to what the next kind of rounds look like, and as companies' trajectory keeps increasing, like how do you personally start to think about follow-on strategy? Like, are your metrics and the kind of filtering process, the evaluation process, is it the same, just applied to a Series B or Series A lens, or does something shift there? Like, what does that shift look like? Like, what do you want to see from companies in that middle phase rather than what you're evaluating during
Ideally,
the 12 weeks?
yeah. Ideally, so we want to follow in our best deals, like most funds. Ideally, the bigger you get, the closer you get to a Nasdaq revenue multiple. So Nasdaq revenue multiple today is somewhere around 20x. So a company doing $1 million is valued 20 million. Company doing 100 million is valued 2 billion. Pretty straightforward. Now, this including in the stock market, so by the way, you want to approach the Nasdaq because your ultimate exit path is probably the Nasdaq. But if it isn't, it's an acquisition, but it's going to be valued somehow similarly. But there's a huge variable in there, which is the speed of growth. And it's the same in the Nasdaq. The Nasdaq average is 20x, but the fastest growing companies in the Nasdaq command a much, much higher multiple. I can think of Snowflake, and Snowflake is growing very quickly. And let me Google right now the valuation of Snowflake. Yeah, it's around 50. That's what I thought. Yeah, it's 50x. So, the average is 20x of the Nasdaq, but Snowflake is 50. That's exactly what I had in mind, because it's a very quick, very fast growing company. So the later, or the more you progress, Series A, B, C, D, etc., towards the closer to the exit, the closer you want to be to that ratio, with that big variable of speed. The fastest growing companies will always. And so again, do you want to be price sensitive and miss the next Snowflake? And sometimes that's the right move, because not every company is the next Snowflake. So or do you want to grab and whatever the price and keep keep going up with that rocket ship? What the big funds do is they're very careful of selecting the best, fastest growing companies, but then they're not price sensitive at all. They just dump the money in there. And sometimes it's a mistake. I think you and we've talked about Instacart, who before IPO big funds came in and doubled, tripled, quadrupled down at a very high valuation, like more than 20 billion, and then it IPO'd, and so they lost money. So that's a very, very late stage. And I'm not a late stage investor, but for Series A, B, and C, I think it still worked out, including in the Instacart case. And so you're going to make money in those rounds regardless if you're, straddle on a rocket ship that's really going up. So that's how I approach it.
Yeah, I think it's a good place to leave it with what you have said frequently about, you never get penalized for buying real estate in Manhattan, and that's what the goal is, not looking for
Exactly.
these areas that you don't know or that you don't understand or that could be these new spaces. It's, there's proof here, it's consistently producing results, and so just keep doubling down.
Exactly. And you could buy, I don't know what's a very low priced real estate in the US. I think every real estate in the US now is expensive, but I don't know, countryside, Wyoming or something somewhere. Maybe Wyoming is expensive. I don't know. I'm wrong,
I
but
think it's very expensive.
it is. Okay. That's real estate I'm not a real estate guy, not anymore. But anyway, Manhattan, yes, you're going to buy at a higher price, but then it ends up, so I'm not a real estate guy because I do real estate in France when I was there, and now in the US I don't care for that very much. But Paris, the real estate goes up 5% a year for the last 30 years, and so Paris is sort of the Manhattan of France in terms of real estate. You can just buy a property in Paris and it's going to go up, or you can buy a property in whatever small town and it's gonna, that's the same thing here. So YC is Manhattan. That's the conclusion here.
Yeah, great.
All right, that's it. Thank you for chatting with us today, and thanks for listening until the end. If you're still here, please consider following us and subscribing on YouTube, giving us a 5-star review on your favorite podcast platform, and I'll see you next week for the new episode of the Lobster Talks. Bye. Hey, thanks for watching. I don't know if you know this, but I have another YouTube channel where it's just me talking about what I'm passionate about, the VC world, startup investing, and YC. You can find it easily on YouTube by typing my name, Gabriel Jarrosson, or clicking the link in the show notes. See you there.